Hello, everyone, and welcome to another insightful episode of Alpha Street's Fund Manager series. Today, I'm truly privileged and honored to have Sandeep Tandon, the founder and chief investment officer at Quant Mutual Fund, with us. With over 3 decades of experience in the capital markets, Sandeep's journey is personally truly inspiring. He began his career in 1992 as a trainee at GIC Mutual Fund, then played pivotal roles in launching IDBI Asset Management. He also has held significant positions at ICICI Securities, Kotak Securities, REFCO, and has contributed his expertise to Economic Times Research Bureau as well. Now, Sandeep is renowned for his innovative approach to investment management, leveraging what we call predictive analytics and the dynamic VLRT investment framework. His book, published in 2019, Being Relevant, delves into decades of research and offers insights into preparing for future market volatility. Under his leadership, Quant Mutual Fund has grown from 488 crores to 84,000 plus crores in less than 4 years. So today, it's a fanboy moment as well for me. Let's explore his market strategies, insights, and the incredible growth story of Quant Mutual Fund. Welcome, Mr. Sandeep.
Yeah, we can start. Hi.
Sandeep, your career spans over 3 decades, starting, as I said in my intro, from GIC Mutual Fund, evolving to founding Quant Mutual Fund at the height of global financial crisis. Can you share some key milestones of your journey and how the principles of being relevant and the predictive analytics that you expound shape your investment philosophy in general?
So, thanks, first of all, thanks a lot for inviting us. The way we look at, I have always been associated with, in today's world, called startup. Okay. Way back in 92, 93, when I did a summer training with GIC Mutual Fund, the mutual fund phenomena was very new. You have only UTI, okay, and UTI was never known as a mutual fund, it was an institution. So, so a unit trust of India. So it's a financial institution. It was known not as a mutual fund. So very early stages of career started as a mutual fund and good where we own a smaller one that gives me a good amount of satisfaction. So right from whether I talk about uh, earlier days of GIC mutual fund, we worked for IDBI mutual fund, then I joined IDBI mutual fund again way back in 95. I was the first employee who got selected in IDBI mutual fund. IDBI was a giant institution, maybe 10th largest in Asia. That's the way IDBI used to be. So it was a very privilege to get a job in IDBI. Yeah, I was the first employee who got selected, and what was my really year experience of 4 months of my training experience that has given me the leverage of being selected. So you can understand what sort of environment how we were infancy stages of the mutual fund. Being very early, say I was started my career or my investment in Harshad phase. Harshad was 92 when this euphoria was there during Harshad phase in India. That's the way I came to the market, and I sold all my family investment. I forced my uncle and dad to invest to liquidate their holding. That was the peak of the cycle, and I felt there was a euphoric moment. Okay, and from those days, and since we spotted that and market collapse after that, that was the way my journey started. So I will always remember that as a euphoria moment. Now we didn't have any capability to define as a euphoria. Okay, I can only feel it, and again doing a postmortem analysis is very easy. Few years later, you felt it was in an industry that was the most euphoric phase Indian market has ever seen. Okay, now obviously we have built analytics and we go back to 1990 and 92 also, and mathematically we can demonstrate that's the time the quant euphoria index was the lifetime high. Okay, now obviously that's the postmortem analysis. That time we have never built it, but it was very early stages of behavior finance to get into. Then I was part of early stages in India, part of Badla market, have traded, and because of our previous organization used to invest in Badla market. So very early stages of understanding behavior finance, uh, some of the terminology which a lot of people are maybe new, chotka, fatka. India was a very evolved market. Okay, much before the derivative future of or forward was evolved globally. We have our own innovative system in India, and by the way, BSE is one of the oldest exchange in Asia. Okay, so that's the way we were early, at least Indian. We were early in this game, so we got very early stages of behavior finance. Got an opportunity to meet best of the brains in the financial market. Today industry has become very big, but that time industry was very small. Got an opportunity to dealt with most of the market veteran in those days, because I was very early stages in the derivative market. Right from inception stages of Indian derivative market, I have been involved, and I have been market leader in that segment for a reasonably long period of time. Till 2018, we were playing that, and we were like top 5 player also in the country. And initially, we were actually number 1, and wherever I worked. So that experience of derivative market, because taught me that leverage market drives the real economy, not other way. In our textbook, we have been taught real economy drives everything. Actually, when you talk about reality, so I'm a student of Pragmatic Institute of Money Management. We have learned whatever we have built, whether we talk about predictive market as an analysis or predictive market thesis or our VLRT framework, which is a byproduct of this thesis itself, has been built from mistakes and blunders. It's not something it just got evolved when we are super genius and we create something unique. That never happened. We have burned our own capital. And in last 33 years, I have been in the market where we have learned from massive mistakes that happen. And the good part about us is that, and as a me as an individual, what we have learned not to repeat the mistakes. If you can build processes around that and ensure that if you don't make the same mistake again, you will be more successful. Okay. See, as a human being, I always believe we will make new mistakes. It's bound to happen. Environment is new, something happening for the first time, maybe in a decade or opportunity sometime come and we don't realize at that moment. But over a period of time, you learn. And that's the reason I say that at least whatever mistakes you have done, don't try to repeat it. That's the way the processes come into picture. That's why Quant is a mutual fund house, or Quant Global Research, the research wing of Quant Group, is all about how we have built analytics over a period of time, how well we are able to quantify the qualitative, quantitative, and the behavior aspect. So we are predominantly a behavior house, but we combine all three thought processes. That's the reason we bring a very unique way of looking at the market into what I call multi-dimensional research. The challenge with industry, I see everything revolves around valuation analytics, which industry very proudly say fundamental work, but we say it's a valuation analytics. The biggest challenge of valuation analytics, when you look at valuation data in isolation, it doesn't work. Okay,
Mm.
and that's the reason I have been saying last 1 year, everybody in India has been talking about India is very expensive because, and but market never corrects. If it corrects hardly and comes back with a vengeance. So what is not right? Okay, are we saying that the valuation analytic thesis which we have been working for donkey's years have not been working? I think that's the way we look at, when you look at in one dimensional aspect, pure valuation, you don't get answer. Let's, when we bring the second dimension, let's talk about liquidity analytics. Okay, and let's compare what was liquidity in 2000, was an important year when market has peaked out. Today's global equity is maybe a few hundred times what was in 2000, what was in 2007-8, the great Lehman movement, which happened where the most of the central bank came together and pumped massive liquidity, and the huge journey started. Everybody still remember that was the biggest liquidity provider. Central banks were working in tandem, and that was the biggest liquidity. It's not true. Today also, global liquidity is few times of that. Okay. Now, so very clear, if you look at second dimension and then you break this liquidity into good and bad liquidity, and the good liquidity in India is it's actually rising. So on the second dimension, we are perfectly all right. Now you bring the third dimension, that is risk appetite or the sentiments data. Okay. Look at what was the perception about India in 2007-8. We verge of collapse. Okay. We barely managed that crisis, the Lehman phase. And versus 2024, India perception is amazingly well. Okay, Indian macro is one of the best in the world. So if you look at today's India perception on absolute basis is good, but on relative basis extraordinary. Now, when you combine all these three analytics, then you get a very different answer. That's the reason we always say VLRT framework, one third weightage on the valuation analytics, one third weightage on the risk appetite analytics, one third weightage on the liquidity analytics, and T, timing as an analytic, is a risk mitigation tool for us. So when we talk about timing aspect, a lot of people look from trading perspective. No, timing is a risk mitigation. Timing is an analytical tool. So timing as an analytic is a function of risk appetite, is a function of liquidity analytics, is a function of valuation analytics. Okay? So when you combine you get much more answers. Okay, since we were talking about the valuation challenges, okay, we all have grown with the same thesis. I have also grown from this, but it took some 10 years for me to undo what I have learned. Okay, and it's
Mm.
very important to understand. Let's look at the challenges. See, criticizing something which has not worked or failed is a very easy thing, but how to improve, that was a challenge. So if you really look at what we understood, why valuation analytics doesn't work properly, because valuation analytics, all the valuation analytics parameters are dependent on one dependent variable called price. Okay, and if you read the cash flow based analytics, most of the whether it's price to sales, price to book, EV to EBITDA, everywhere the price aspect comes into picture, and hence we are all slave of prices. When prices moves up and down, your conviction also changes. Analysts' recommendation also changes. And I have seen most of the time, again from the industry, not criticizing about it, majority of the people, including us in the past, used to do postmortem analysis. Okay,
Mm.
earnings as announced, call has happened, and then analysts will do upgrade or downgrade. By the time that event is over, it has already played out. Either you do other way of looking at that, I take a preemptive approach. Okay, that I preempt something. Some people take contra approach. I'm contrarian. Okay, but as a quant mutual fund, we take a data driven approach. Okay, and that makes a lot of difference to us. What actually I'm trying to do, we are trying to do in our quant global research, we are trying to reduce the dependency of this dependent variable called price by significant levels. Okay, so when we bring in VRT framework, two-third is macro data. So now valuation analytics only one-third. And within one-third also, the way we have defined our valuation analytics, that ultimately I'm able to achieve or able to reduce the weightage of this dependent variable cost price by below 9%. Okay. And when you do that, your biases goes away. Okay. And this is something which I have learned is all about biases. So when we talk about all theoretically, we can talk about different types of biases coming into picture, but those are all theoretical exercise. In real life, is very difficult to quantify that. Quant mutual fund as a house is very unique about that. Everything we try to quantify. That's the name comes on the background. We quantify anything which affects market. Whether you talk about geopolitical volatility, you talk about earth analytics, you talk about perception analytics, or liquidity analytics, or sentiment analytics, any sort of analytics which really plays a role in either defining the markets or quantifying something really helps. Let's take one more example. Whole industry works on the concept of forecasting the earnings. Okay,
Mm.
3 years, 5 years earning, and majority of the people based on futures earning take the course. Okay, and the biggest challenge of this thesis is that it is based on certain assumptions. Okay, when assumption changes, you have positive surprise or negative surprise. Okay,
Correct.
ultimately assumption based. So as quant mutual fund, we don't like to do anything which is assumption based. Okay, so we typically take these data points as a historical only, and earnings, this forecast we took only as a catalyst. So it's not a main driver in our thesis or our models which we look at. These are only act as a catalyst. The challenge is nobody defines the multiple aspect. Okay, so when you talk about P multiple or EV to say any number, any, let's say simple, let's keep it simple, price to book or price to sales, or let's say P ratio itself. Nobody forecasts. This is actually a balancing number. When analyst wants to upgrade the, like, let's say earnings rallied by growth is 5%, and you want to increase the target, so what you change, you drastically change the multiple, and that's the way it's a balancing number. Your targets can be changed. So I can, as an analyst, can upgrade and downgrade by just playing by the valuation multiple itself, and that is a very subjective exercise. Okay, at quant we always say objectivity is our religion and data is God. There's no scope for subjectivity. So we always believe that don't get into subject. The moment you have subjectivity, the problem starts. Then biases comes into picture, and hence it is our focus area that how to resolve this problem. So we have built something called perception analytics. How, with the help of perception analytics, we can quantify whether perception is speaking out both in absolute terms and relative terms. Is very important for us to understand. When they see reach, when let's say perception for a sector or stock reach a inflection points, I'm a seller. When it hits, so when it peaks out, it means they hit the most admired territory. We move out from a behavior perspective, and market is, let's say stock is corrected significantly and hit the most neglected zone, or what sometimes I call most hated zone. that's the time we will be buyer, because that's an extreme inflection point. So since Quant Mutual Fund, we specialize in inflection point. We are saying we are in inflection point strategist, and we are not momentum house. A lot of people consider we are a momentum house, okay? Because globally, majority of the fund managers are momentum traders, okay, and so is the case with the trader, because everything is all about momentum. Somebody defined price as a momentum, somebody says earnings as a momentum, which also has its own flaws, or somebody look could be a combination of this momentum. So what is important for us, that extreme inflection point, something which really help us in taking a bigger longer term call or medium term call.
Excellent, excellent. You mentioned about timing analytics. That's the first time I'm hearing. And Quant as a fund house, is highly regarded for your exit strategies. For the timing and effectiveness of when you take an exit. You did mention about it, but can you elaborate your approach on exiting the investments, especially in volatile markets like what we are seeing now? And what are the principles that guide your decision making in just the exit portion?
So let me touch base on timing, and then we'll come to, because it's a link question. What we have been taught, this is one of the important thing we have taught, is all about that nobody should try to time the market. Timing is bad. Okay, time in the market is important. I agree, time in the market is important, because that's how you experience how much time you spend in the market. But timing is important, okay. I believe that as a student of management, we have been taught, okay, right place, right time. Every businessman wants to time the market, and this is all about, if you're not on right time, you will miss out opportunity, okay.
True.
Whether talk about product launch, or even government wants to time it, okay. Timing is such a deep root sub, it is actually so deep rooted in our subconscious mind, we can't even ignore it. Whatever people will say, I don't time, timing is bad, trust me, same guys actually wants to time the market, because the human psyche tell me, you don't want to time the market, you don't want to be successful, I want to time the market, okay. But timing is a risk mitigation. When you
Mhm.
start understanding from everything at Quant Mutual Fund, we say from risk perspective, we very nicely say we are in the business of risk management. Returns are byproduct. We manage risk very well, okay, and that makes hell lot of difference when you start looking at the perception instead of chasing the prices or momentum which people happen. So typically you land up in a situation where you at the peak of the cycle you are sucked in, at the bottom of the cycle you are capitulated. So when we talk about timing, so obviously let's understand, for us at Quant Mutual Fund, we always talk about entry is important, but exits are more important. We always say buying is art and selling is a data science. Okay. A lot of people can buy it by just observation. Okay, product launch is good, the queue is there, let's say automobiles company. People think the experience has been good, it's a very comfortable thing. So it's based on your observation, you can identify if so and so particular stocks looks good because of these reasons. But but when it comes to exit, most of people have huge emotional attachment. This stock has given extraordinary return. This is something good. At the peak of the cycle, best of the analysts have a strong buy recommendation. Massive upgrades will be coming. Okay. And they will be all part of various indices, MSCI inclusion, Nifty inclusion, all those things will happen. I'm just not pinpointing one example. Okay. The noise, okay, around this thing will be there. So you will be in a situation where the narrative will be so perfect. Okay. There's a picture perfect narrative when you get, that's the time our data tells us this is the peaking characteristic, move out. Okay. And that make a lot of difference how you look at. So let's say give you some live example. Day for yesterday, market meltdown in India happened. So the PSUs were down 20-25%. If indices were down 8%, small, mid, okay. Luckily, we didn't hit the lower circuit. Okay. But we are approaching in that direction. So I was one of the a couple of channels I came and said that India VIX is now at 31%. We think it's peaking out. Majority of the charters will tell you it's breaking out. Okay. So it's new high, new breakout. Now it's going to the next level. Okay. So it's a characteristic. Now with the behavior perspective, our thesis was that it's peaking out and it cannot sustain beyond 2-3%. And good news is that finally corrected. It corrected 27% yesterday and today
Correct.
7%. The more than 30% or 32% is already correct.
Correct.
But at that moment, nobody was willing to stick their neck out and say what will happen. People are shit worried. So our behavior data point was showing the fear in the market was extraordinary. People were getting capitulated. When you build these systems, it's built when you are in normal environment, when you have rational thinking and you build it. And these analytics really help us in difficult time. What happened day for yesterday? We could be the only house on the media is saying that one should be aggressive buyer. Okay, don't sell anything. These are time. These are like God-given opportunity. Sometimes extraordinary events happen, which gives you extraordinary buying opportunity, and we actually wait for those moments. Okay, and it is God-given opportunity if you have. But what was the situation? People were so scared they didn't have guts to buy. Then market rallied yesterday, when today's rallying right now. Okay, the perception changes. So some of the analytics which we look at, not only the end of the day, we look at even the data also. Okay, that makes hell lot of difference in our thinking process. And you remain. This is ultimately this business is very mind game. You know how well you can play. So we play on human psyche. Okay, as a behavior investing, you say when extreme people say fear and greed, but everybody talks about a fear greed, but nobody quantify fear and greed. Okay? So we move to the next level and we quantify and fear greed. Yesterday, the fear was extraordinary. Okay, and therefore yesterday the greed was extraordinary. When the exit result came, everybody was sucked in. People think that now they will miss out. Something has already changed. So that is the way we try to capitalize these inflection points and try to have early exits or early entry points. Sometimes you're early, you have to live with those pains. But the good part is that when you buy and sell the inflection points, your upside and downside both are limited. Okay. It's not like when you buy in the inflection point, the lower levels. I know my downside is limited. When I'm selling at the peak of the cycle, we know upside could be there and nobody can time the exact exit or exact bottoms. But once you start hitting those what to call it, the neglected zone, the admired zone, we get opportunity to flip, and this is what exactly we do.
Excellent, excellent. Shifting gears a little bit, you have mentioned about the global uncertainties. From 27, an inflection point has happened till 2047. We are going to see geopolitical changes. Indian elections, you just touched upon, done and dusted. Now at least there is some visibility, shaky visibility at least. But then the US elections are impending. The superpower is trying to, you know, get the second guy, keep quiet, and all that stuff. So the geopolitical tensions, you have small wars breaking out everywhere. Given the current global market conditions, if I were to ask you to, sort of quantify the future outlook for next 6 to 12 months, how do you foresee the period with these heightened uncertainties impacting investment strategies per se? Let me put it that way.
So I have been very vocal about the last few months. I'm been in various media houses. Easy phase of Bulldon is over in India. So one should be very clear. Yes, in India, we are in decisive. I can talk globally also, but let's focus on India for a few minutes. Uh, the easy phase of India is over. The bull run is over. We are in decisive bull run, but we are in difficult phase of, which means that anything you buy, any sector you touch, next 6 months you will going to make tons of money in that phase. Maybe there's a probability the next 6 months you actually lose your capital and some of your investment. That's the scenario. But if you can mitigate your risk by doing sector rotation, stock rotation, based on the sectoral preferences or the data analytics which you do get that sense, and you can still generate massive alpha in the current level because we are indecisive. So that's the way I define the market, and people like us can really optimize it. Okay, let's say example, since you talked about geopolitical, I've been myself an option trader in the past. We have very used to run very large prop desk in the country. 10 years I run that prop, and maybe in those 10 years, not a single year was ever negative. Okay? Yes, many monthly is negative. I don't think we have any quarterly also any negative. Lehman we made very tons of money. That's the way Genesis. So in Lehman crisis, actually we made very sizable money. Okay, and with a limited capital, we made that. That's the way we are able to build multiple business after that. Now, when we talk about, let's say, volatility, people generally, money managers and analysts as a community or investor as a community, like a lot of people generally make this statement: let this dust settle down, let's volatility settle down. I don't mind buying 5-7% higher But I don't want to be part of this noise which is there. They call it noise and disturbance because they are not equipped to handle that volatility. Okay, we actually thrive volatility. Okay, volatility is our best friend. I always say if you can make this invisible animal called volatility as your best friend, then you will be very successful. The moment you start hating is something you don't like, you don't understand, the problem starts. When you become friendly with this volatility, it means you understand. You have arts of managing that volatility. So when we're talking about art of managing known risk as well as unknown risk, and if you can manage known and unknown risk better, you will able to generate alpha out of it. Let me give you a very small example. I have important myth in the market. Everybody talks about long term. I agree, investors are long term, asset classes are long term, but stocks and sectors are definitely long term, are not long term. We have been taught few wrong things. These are blue chip companies. It's a long thing. You can buy and hold and forget in your portfolio. Okay, so I can tell you whether it's S&P or even Sensex India. What was the Sensex in 1990? So-called blue chip company don't. Majority of those companies don't exist today. And if they exist, they are not part of index. Maybe few companies, maybe two, three companies which were part of Sensex at that time, still are part of Sensex. Majority of company are no more blue chip company, but sometimes we have been taught these are blue chip. So let me come again address this question from a risk perspective. Why everybody talks about long term? Because managing long term risk is very easy. Your mistakes are hidden, and you if you have make few mistakes, let's say even 10 odd mistake you made in 10 years, it is hidden, doesn't make difference to you. So why that's the way I call it long term investment is a lazy style of money management because you stay mistakes are hidden. And this thesis is now I'm talking about India is no more mature, it's no more emerging market, it's actually quite developed market, okay, quite evolved market. This thesis work in the emerging market, maybe it can work still in let's say in African countries, which is still evolving. But if you talk about in India or Singapore or even China or you talk about Indonesia, they are fairly evolved economies, okay, or evolved market. I don't think this thesis will work. So what is very important to understand that if you manage your medium term and short or near term risk or even short term risk better, not only you protect your downside, actually generate alpha out of it. And this is what exactly we do. We generate small alpha in a shorter and medium duration time also, because I don't buy everything for 10 years. Every stock I don't buy for 10 years perspective. Okay? Because every individual has needs, long term needs, medium term, short term. You can't say I want to enjoy my holiday, but I let me save for 20 years, then I will be eligible for holidays. Okay, now you can't pamper even yourself. He says, I want to enjoy the restaurant. No, I have to save first. After 3 years, I will go. Let me have a saving first. That's not the way you do it, correct? So if you have products which can offer you medium term returns, short term returns, and long term returns that are apt product for you. And this is the way we manage our treasury style money management with the philosophy we talked about. So we manage like a treasury. Idea is not to lose the capital. Because what
Hmm.
happened typically, I have been investor for a long period of time. When you raise money, you take money and by showcasing your previous track record, certain IRA you promise, this is what you can deliver. Obviously, nobody gives guarantee, but this is what happens. So when you collect money, you are absolute guy, absolute return product. But let's say 3 years later, when markets are down and you say market is down 15%, I have only correct, I have down only to 12%. So I have outperformed 3%. So when you take money, you are absolute return product. When you deliver, you are relative product. I outperform. And this is what investors don't like it. After 3 years, if I take your money and say, okay, I have generated negative alpha for whatever reasons, irrespective of the market condition, you may not like it. And hence, it is very important for us to understand how you manage money in difficult example, and that becomes like a treasury style. So in a treasury, the treasurer does not have a mindset to generate few quarters negative return. Maybe if unknown risk hit him, a quarter is maximum. Worst case scenario, 2 quarters will be example like COVID happened in March 2020, or Lehman moment happened, or some let's say in February 2020 uh, is this Russia-Ukraine battle happened. So those unknown thing people still manage. But when you manage money like a treasury, so we have a view, we manage our long term, medium term, hedge call, cash call, near term, special situation, all sort of risks we manage parallel. Okay, and that gives us comfort because parallelly we are managing all sort of thing. So some portion of my portfolio is also short term, some portion of my portfolio is also medium term, and 70% is my long term. But in that 30% we generate alpha. Okay, so let me give example for, let's say, talking about last few years. So calendar years and COVID onwards, 2022, 20 was positive year for the whole industry, 21 very good. Calendar year 2022, industry has given negative return, and majority of the mutual fund schemes also have given negative returns. Quant was the one fund house. All scheme has given positive return, including small cap. So we deliver in negative returns period 10% to 30% returns. So that give you that alpha can be generated negative. Let's give you one more example how the dynamic style of money management works. In June 2023, okay, we launched our BFSI fund in India. And first 6 months, I remember, strictly remember, I think index, the BFSI benchmark has generated closer to 2% return. Okay, and some other benchmark has were flat or even negative. So let's say even 2% return for discussion's sake. In the same period, our BFSI fund delivered 64% return. Okay, and which was higher than at that time than smaller cap and the Nifty itself. So when the benchmark index has not delivered or flat to negative returns, you have given outperformance of 62%. Okay, and that makes big difference when you talk about dynamic style management. See, because I always say we live in a very dynamic world. Our money management style cannot be static, buy, hold, and then you forget it. That's not the model we practice, because we believe that we have to continuously rebalance our portfolio, reconstruct our portfolio based on the risk of environment. And the challenge is that people do postmortem analysis and you say after risk on period you realize, oh, that was a risk on period, oh, that was the risk off period. Okay, so we not only quantify the risk on risk of environment, but we also quantify the impossible intensity of risk on risk of environment through our predictive analytics. This is what we do. Instead of doing a postmortem analysis, we do some amount of predictive analytics, and we have been reasonably successful in generating superior risk adjusted return for our investors.
Excellent. While reading up, I was pleasantly surprised in your predictive framework. You had mentioned something called Earth analytics. Now we have unknown risk, but climate change is, I think, right now a known risk. So explain to us what is Earth analytics and what are we talking about here?
So to be candid with you, in 2012, when we were working for Futurist Perspective, we spotted that that next biggest bull run will come in the agri side. When we're talking about agri as a commodity as a space, we spotted from based on our cycle analysis some data we were looking at 2020 till 2030. That particular decade will be generate massive returns for the. We have talked about 100 to 1,000% return in that, and we were trying to get multiple answer through market implied analytics or through cycle analysis. What could be the reason why this sort of returns or this sort of up move can happen? Then we spotted that if agri prices globally will move up, it can only happen either it can happen because of the supply constraint, and supply constraint can only happen with the weather condition. If you have horrible weather condition or a negative work environment for you, and so we started working. So 9 years I myself have worked on the Earth analytics. We try to understand what type of environment would be by 2020, because it has been now fashion to talk about climate change, and every political party, every business house, every global leaders will talk, but nobody quantifies. They give you all fear of or changing climate condition, the impact which will happen, all all sort of possible theoretical thing, okay, but nobody quantify. So we have put in some effort through our Earth analytics, and we are able to quantify. If I have to take few decades view, we are able to do through the help of analytics, and that's something which we have invested a lot of money. We dealt with a lot of geologists also, and we have spent considerable amount of time and money in understanding this thesis, and we are able to evolve a lot. In our book we are referring, we have actually covered a whole chapter about Earth analytics, how magnetic fields affect the economy, how various data points affect. Our focus is market, our focus is financial market, that is our small domain. So we don't get into a theoretical exercise. We don't have to write a white paper on these things. Okay, we will understand what is relevant from our financial market or macro or global economy perspective. Our focus is very clearly defined. We don't deviate beyond that. Otherwise, this is a big you can do as much research as you can, and then can be completely lost. Okay, so we do a little bit of it, which help us in taking a call, because we ultimately were a student of market cycles. We subscribe a lot of data. We have 1,100 years of data of various kind of commodities or yields, okay, and sometimes 1,000 years of wheat data. So we have a lot of data. So that's the where we spend good amount of money. So it's an analytic form. Okay, so we say objective is a religion, data is God, and everything revolves around data. That's the way this firm has been built up.
Excellent. The last 4 years, especially, you mentioned, the index has not given the returns, whereas, even some indexes that were in negative, you actually, outperformed. I believe what from 500, close to 500 crores, you have now at 50,000 crores plus AUM in the last 4 years alone.
Yeah, we are
And
nearly 87,000 crores now.
okay, excellent. 3,000 more than what my data says.
Yeah.
So some say, okay, as the AUM grew, now the performance will come down. But some say no, they have outperformed even when their AUM is at an all-time high. Now, from your vantage point, how do you ensure consistent top performance across your fund schemes, even at much higher AUMs going forward?
See, we have grown with lot many myths. As I said, we have to undo lot of wrong teaching which we have learned. This is one teaching we have been taught. Okay, with size, returns comes down. So again, a classic example of lazy style of money management. When you can't deliver, you start blaming size. If size is a problem, please return the money. And this is what happened in US market. Nobody returns money. So this gives a lecture. Okay, there's a theoretical exercise, nothing beyond that. As a student of economics, we have talked about economics of scale. Okay, as size grows up, your benefits also should rise. That's the way we are taking advantage of it. Let's take example. If we are growing our size, let's say small cap, which was some 40 odd lakh rupees, okay, and now it is 22,000 or 21,000 crore rupees, nothing. But if you look at our performance of small cap, which size actually our outperformance has risen significantly. Okay? Now, what is the magic behind that? If somebody has to understand, very simple. As we are growing, capital market depth and breadth is also okay. So it's not like we are growing in isolation and hence we don't have desired liquidity in the market. So liquidity is also increasing, depth is also increasing. What is important to understand? Let's say IPO comes. Okay? Last 4 years, Indian IPO market has been extraordinary. If you really exclude the IPO benefit in most of the schemes which people got it, then performance is below average. Okay? Because of allocation, because of sheer size of your fund allocation, you were in the tier one allocation and you got highest allocation and you made extraordinary money there. Okay. And if you are as a small mutual fund, nobody's bothered about it. You don't even consider for allocation. As now we are getting size, this one important benefit which we are getting. Okay. Though if this benefit could have been more when you were in the easy phase of program, okay, which was the case for the our other mutual fund houses, because they have been in this business for a while and they have a benefit of size. Okay, that's point number two. Point number two, what is very important to understand, liquidity is always highest at the peak of the cycle and liquidity is always high at the bottom of the cycle. So if you can exit at the peak and rebuild your exposure at the bottom of the cycle, you always will be a winner. Third point is about the derivative usage. Okay. Now, we have been a very large player in the past. Derivative markets are 10, 20 times more liquid in the cash market. And hence we use that product also to bring down our impact cost. Okay. And that really help us in our entry and exit points also. Okay. Now, point number four, and very important, is all about as you have grown, your corporate access becomes easy. At 5,000 crores, let's say, if you're managing, uh, let's say 10, $12 million, okay, nobody was corporate was not willing to entertain your call also, forget the meeting request. Okay, at $10 billion of assets, majority of the managements are willing to meet us and they're willing to come to our office also. So I'm seeing the whole perception change. It saves your time, it gives you better perspective, you're able to talk to them, it gives you an edge. So corporate access also becomes a very meaningful edge. So there, and I can talk about many more examples how size gives you edge. Okay, so if something economic of scale has been taught in economics, is right. What money manager are telling you, this is a lazy style of money management. Size gives me difficulty. Then please return the capital.
You're very outspoken. Excellent. I noticed recently you picked up a sizable stake in a QIP, one of the energy companies. I'm not, taking the names. So, sort of help us understand the investment thesis behind that decision. And is this like a global upcycle in commodities? Do you expect? Though there are negative impacts on stock prices. What are your sort of views on sunrise sectors? Something for my listeners as key takeaway.
So obviously, from compliance perspective, we generally don't talk about stocks. Okay, but in general, I want to only share that we as a house, from our research perspective, we believe leverage economy as a concept will lose its relevance. Is already losing its relevance, and maybe by 2047, it will lose its relevance completely. Okay, and what it means, the relevance of real economies, real real asset class. So we talk about any asset class. We will talk about commodities also will grow. So now we believe commodities are in super cycle or in secular up move. I don't want to call it bull run because bull run has its own connotation. So I say it's up move. Okay, so they are in secular up move. Okay, and that is the way we believe that America as a country will lose its relevance. Banking as a sector will lose its relevance. They are all byproduct of leverage economy as a concept. Okay? And in last many, maybe I can say in last many decades, leverage economy as a concept has gathered momentum, and today leverage economy drives the real economy, not vice versa. And I think that cycle has started reversing, and that will make a lot of meaningful shift in terms of the way sector allocation will happen, how the relevance of developed economy will lose, how money will shift from east to west and from west to east, and within that, uh, if I have to call it Asia-centric thing, and even let's say 10% of liquidity shift from US to Asia-centric economy, particularly India, there is tsunami. Okay, so that's the way I defined. So don't look at just valuation analytic in isolation doesn't give you any answers. Okay, you will be a lost person because you're looking at one dimension. And in today's, if you go by Vedas, we have 64 dimensions. Okay, so if you get into a theory of relativity, talk about multiple universe. Okay, so all those things are part of a life. How well you can drill down and down, and you can able to quantify how and why it is affecting you. And that's the way we try to filter it. So we are student of both absolute numbers and relative numbers. That's because everything in life is a student of theory relative. Everything is relative. Returns are also relative. So absolutes are good, relatives are important. And what is very important, because absolute is like you say is a fair value. Absolute is very bizarre concept. Okay, it can be as abstract as it can be. It's very difficult to quantify that part. When you combine qualitative, quantitative, and behavior aspect, that's the reason you get better answer. If you're just looking at the qualitative, you won't get all answers.
Excellent. Shifting gears a little bit, Quant Mutual Fund House, right? You are strong proponents of active investing. Now, there is this school of thought propagated in the US, like so Vanguard and all, indexing. Uh, but your outperformance, irrespective of the market cycle, proves that active investing is good. So now, for those listeners, who are young earners in India, what should be their asset allocation? You also mentioned don't have too much delayed gratification also. So what should be an ideal mix of investments, and uh, should he pick active funds over index funds, or should it be a mix of both? What are your views on how somebody who's listening to this, we have 50,000 plus subscribers, so most of them are trying to understand how they should invest.
So first of all, very simple thumb rule. If you can see in the easy phase of bull run, passive products will do very well because they are very cost effective product in the bull run. And in the difficult phase, active fund will outperform passive fund, and passive fund will underperform the benchmark decisively. By default, it will be. Okay. Now let's understand for a minute the success of passive. What lead to the growth of passive fund globally? Okay. I have seen this momentum actually came from 2012 onwards. The passive side is a big globally. Post Lehman, one important event happened. The liquidity crisis, which we saw in 2007, 8, 2000, September 2008. That sort of liquidity crisis we have never seen in our life, at least. Okay, I don't remember any events which was defined as a liquidity issues. global liquidity was completely sucked, and then some of the banks became bankrupt. So after that, the fear among active money management was so high, they were actually lost people. They really don't know what to do now because something new has hit them. And that's the reason people were playing safe. And globally, I'm not talking to India, people globally started hugging the indices. So if you are a long holding, the tendency of having 70-80% hugging towards index gives them comfort that I will not be at least outlier. Okay, I will fall in line if I'm following 80% in the index and 15-20% I put in mid and small. That gives me upside also. So I will always outperform my respective benchmark, and I'm protecting my downside. So that thesis gathered momentum, and that's the way passive product. This is the way active started doing. Now investors are even more smarter. They understood this math that you are offering me a quasi-passive product and charging me active money management fees. Okay, and that's the way the active money management lost their relevance, and passive product came into picture. Okay, now India also I'm seeing people are selling us a new segment. Passive is a new product. No, it's a failure of active money manager, and that's the way passive has grown. I'm a very strong opinion about active. This decade belongs to active money manager because the global volatility will remain very high. In this period, passive product will not differ. Okay, it's not like we don't have any product and hence we are offering a very biased view. This is my risk analytical view. The active money manager, not only people like us, globally will outperform this phase.
Excellent. Before I wrap up, I'm going to ask you sort of to crystal ball glaze into 2047. At in 20 right now we are in 2024. For posterity's sake, let's assume this video is still on and somebody watching in 2047. What will be the position of Asia and India in general in the global mix? You mentioned about the leverage economies getting hammered and stuff. So where do you see India in 2047, and who do you think will be replacing US, if at all?
Okay. So some of these things we have covered in our new book, which is largely ready, can be released in some time. And see, 2047, why we chose 2047? Because we call it 2017 till 2047 as a great transition phase. We have written about in our previous book itself, where we said 2017 onwards, global reset happens. Okay? And now we are extending this thesis, saying that instead of using the word global reset, we are saying how the great transition, because that's actually a transition phase, okay? Where country like India will re-emerge. We believe by 2047, India demographic cycle begins. And that's the reason that 2047 year was chosen, not as that 100 years of celebration of 100 years. That's not the way, that's a political definition. For us, this is the way we define, because demographic cycle people and a lot of things are linked with demographic cycle. Is a very important data for us. What I believe that by 2047, when you say the relevance of leverage economy will go, which means by 2047, America dollar will not be a reserve currency. It's like US is a very large economy. I don't think it's going to collapse the way a lot of people talk about. I think it's a big ship. Okay, but I will not worried about the collapsing aspect. I think I look at everything from relevance perspective. America as a country, leverage economy as a concept, it lost its relevance. So America will lose its relevance. It will remain as an important economy in the world. Answer is yes. The relevance will be lost. A country like India will re-emerge, and the relevance of India or Asia-centric economies will get the peak of the cycle. And so-called some of the developed market, our view is that Japan, which has been a so-called second largest economy in the world, okay, or third largest now, or maybe fourth largest, depending how you look at, is going to lose its relevance significantly. We believe we have written in our book in 2019 itself when yen was around 101. We think yen will collapse. A lot of people were celebrated that devaluation of yen leads to a better economic prospect. Yes, we talked about by 2020, end of 2023, Japan market will hit all-time high, okay, which happened. Our view is that beyond 175, JPY or yen as a currency will collapse. Okay, so far depreciation of has been celebrated as well. At some point of time, it will just collapse. And the relevance of Japan is something which is we are very worried. And India will be the biggest beneficiary of that event. So we say Japan, so far we have seen China plus one. I think Germany plus one is knocking over this. And Japan plus one will be one of the biggest event for us. Okay, from a longer term perspective, a lot of things will be built in India because of sheer size or manufacturing pieces of the current your country is getting evolved. So we remain very constructive about India. We think maybe by 2047, some of the other economy, Europe will not exist in this form. Maybe bigger economy like France may not be, maybe not be top five economies in the world. They will lose their relevance. So lot many radical changes we see. We believe that global volatility cycle should peak out. Okay, maybe by 2033, 36 sort of thing. When maybe after that world will be very different. We believe in our book we have talked about how a spirituality cycle will come back, how India became a spiritual leader, a new thought leader. If I have to say the word right word, India will emerge as a new thought leader, global perspective, and India. I don't know about whether India will be the largest economy or not. Uh, but what is very from the wealth perspective, India will be the wealthiest country in the world because we are very optimistic from the bullion perspective, or the precious metal perspective. That cycle is yet to be played out, and as an Indian, every right from mids also driver also have huge amount right from the lower status of the society. Okay, I think India will be in a very unique situation from a wealth perspective, and maybe too premature to visualize everything. But these are the data points we're showcasing. So, in all, I'll say India will be forced to reckon by 2047, and India will emerge as a unique asset class itself. So that's the way bullishness about India. We say this big decade belongs to India, maybe half century belongs to India.
Excellent, excellent. On that very bullish note, let's thank Sandeep ji for taking his time out and giving us his insights into the markets and the investment philosophies. Sandeep ji, it's been an absolute pleasure catching up with you, and I look forward to more such interactions in the future.
Thanks, Balakrishnan. Thanks a lot for inviting us.
Thank you.